I do want to start off with the Treasury market for a second, because that has been the tail that's wagging the dog. And it's not just about the level of rates anymore. It is about the volatility and these sort of extreme moves up and down. How much does that unsettle equity of investors, if at all?
So look, I think it's the fact that we've had such a big move without interruption. Yeah. If you look back over time, and we did a big study on this where we just went back to the 60s actually, so rising rate and falling rate periods, and we just looked at what equities do during different yield surges in the 10-year. And we found that if it's kind of a baby surge, so 275 basis points or less, equities tend to go up in that environment. They can handle that. But we've seen pretty consistently that when the yield surge is more than that, without taking a decent pause, that equity markets tend to go down. And this time around, if you use April as the starting point, we'll get to that threshold a little before 6%. So we've still got a little bit of room. We can get out of this without too much damage. But I'd be lying if I denied the fact that this is kind of the trouble spot. Like we're in a different place now that we've hit 5%.
How comfortable, though, can you be, or any real equity investor be, if yields stay at this level? Let's just say the volatility tamps down. We don't get a meaningful jump up further from where we are right now. Is that something investors can live with? So
I think you do have to reprice your PE multiple, but our back testing, which again goes back to the 1960s, suggests that we can still sustain something around 20 times, which is a bit higher than most people assume. So you do have to pay a bit of a price. Your multiple is going to get clipped, but it's probably, not as much of a clip as people anticipate. The other thing I would tell you is that if you look at balance sheets for corporations, whether you're looking at big cap S&P companies or Russell 2000 companies, basically debt is high, but it's long-term debt, and they've really locked in low interest rates. And so if you look at the effective interest rate on the debt outstanding, whether it's S&P companies or Russell 2000 companies, you're talking like 3.1, 4.4%. And so it is creeping up, but it does look manageable. And if you look at how companies are managing their balance sheets, they're doing less on buybacks. We've actually seen the S&P's dividend yield come down, but guess what? A lot of companies are talking about deleveraging. So they're really built to weather this storm, and they're managing it very prudently. This is more psychological than I think actual risk.